Hello, everybody. Welcome to the technical analysis webinar. We'll be getting started at this time. If you would, before we get going, just give me a quick okay in the chat box if you're hearing me clearly and seeing my screen all right. All right, great. Thank you. I've got enough responses. If anyone has any trouble as we go along, just let me know. Quite a bit going on with the fundamentals that drove some movements today, creating some great technical entry points and exit points, and some re-entries that are potential right now. So we'll take a look at some technical strategies on the charts in just a moment. As always, keep in mind, no one trade is guaranteed to have profits. All investments have risk. The same is true when you're trading CFDs, spread betting, options. There's risk involved with each move that you take, but quite obviously there's also a good potential profit with each move as well, which is why we're all here. So the idea is to manage your risk in a way that makes sense for you and go after those potential profits, and hopefully with what you've already learned and with things you can pick up additionally to add to your strategies or to build new strategies, hopefully you can improve upon your profit margin so you can be amongst those that profit long term. It's a minority of traders that are able to profit long term, and it's not easy, but there's a good percentage that do, and it's a really good percentage of those who actually take the time to develop a strategy that is based on technical analysis, fundamental analysis, that's well thought out in terms of risk management. And when you put all those tools together, many of the things with which we cover in the webinars, it really puts you in a better spot to be able to be amongst those who can profit long term. So keep in mind what we cover is from an educational perspective, not meant to be taken as financial advisement, and you can find the full risk disclosure statement on our website. So what is technical analysis? Real quick, it is looking at the historical movements of whichever asset we're looking at on the charts, and typically we're looking at candlestick charts when we're doing this, and it's trying to find repetitive patterns, reversal points, something that gives you an advantage to hopefully help you predict maybe what might happen in the future based on repetitive patterns or things that have happened in the past. And so what happened in the past is no guarantee to be repeated in the future, but many times it can help you improve upon your win percentage if you take those historical movements into account and work the technical strategies that can go along with them. There are a couple different ways to do technical analysis. We tend to lean on manual methods of technical analysis in the webinars because that makes you have to learn really what the price levels are, what's happening with them, to be able to understand really what's going on the charts when you make your decision about entry points and exit points. Indicators try to do that for you. They look at the historical data. They're programmed to look back a certain distance. They give you some type of graphical representation and make it very easy to tell you over a certain time period that maybe that indicator thinks it's time to sell because things are overbought, or time to buy because things are oversold, based on the programming of that indicator. And they can be very helpful. I find indicators to be more helpful in a supplemental way, meaning find what you believe on the chart first with your own manual methods of technical analysis, and then see if the indicators agree with you at certain entry points. And when you can align maybe the indicator agreeing with you at the same time that you thought the same thing, then maybe those are the signals you trust the most. Those are the moves maybe you trust the most. And that's kind of the way I use the indicators in the webinars. Last week, we took a look at Fibonacci levels, and we compared those after we drew our own support and resistance levels on the charts. We compared the Fibonacci levels and said, oh, this one looks really good. The other ones don't line up, or 2/3 of them lined up and 1/3 didn't. So maybe we trusted the spot where the Fibonacci levels lined up perfectly with our own price levels, and that many times can work very well. So that's kind of the approach we'll be taking with our technical analysis. If anyone has questions, wants to give input, please don't wait to the end of the webinar. You can chime in at any time if you want me to repeat something, or you think you want to add something for everybody else to hear or look at, please feel free in the chat box to communicate. All right, so quickly we'll look at the fundamental news before we get on my demo account to look at the live movements. So let's look what's happening in the news. First thing, before we get to the news, I want to show you here is on our main website, if you go to the Trading Platforms tab, one of the platform options for you to trade on, Charlie, it's okay that you're a little late. We haven't gotten to the good stuff yet. The trading platforms, obviously we have MetaTrader 4, MetaTrader 5. We offer options trading, but what I wanted to show you was AvaTrade Go, our mobile app developed specifically by AvaTrade for AvaTrade traders, has some special features on it. So you can download the AvaGo app from here or in your app store. And when you have the app, you'll see that it does some things for you, especially for beginning traders, but also for advanced traders. It's nice to have the order window as you're setting up a trade to buy or sell. It's nice that when you put the trade size, it tells you how much margin is required in your account currency. It also, if you put take profit or stop loss, will tell you how much you're risking in your account currency to the stop loss, what your potential profit will be to the take profit. So you don't need a trading calculator. It does all of this for you, which is very convenient. It's nice. Even if you do your charting on the full screen, like we'll look at in a little bit on my MT4 account, you still could use the app to place the trade because it does these calculations for you. And then another feature you'll see only on the app is AvaProtect. It's on gold, silver, and most all FX pairings. There's lots of time frames from 1 hour to several days in length where you can cover against any and all losses during the covered time period. If the coverage ends and you have any negative floating, it's added back to your account, the trade keeps running. If you want to close the trade before the coverage is over because it reached, let's say you're buying on gold and it dropped to a support level and you say, okay, now I think it'll go back up, you can manually close the trade, collect the payment from AvaProtect, and then reopen if you think it'll go the correct way from that point. Now, obviously, when you enter into a trade, you hope it goes the right way. And if it does, then all of your profits are yours. You only get charged this small premium at the start of the trade for the benefit of that protection. So it's a nice feature, especially when you think there's going to be a lot of volatility like there's been today. Okay, very, very well could have paid off today with some moves if you read things wrong, maybe. Okay, and as we said, no one trade is guaranteed to profit. So it's always nice to have some risk management tools. That's an additional tool that AvaTrade offers. Now, what's been happening today? This was the story all day. Wall Street gripped with fear. Okay. Fresh fear about a second virus wave. And boy, the volatility index was up like 20% earlier today. What a turnaround. Everything was red. Now everything's turned green almost, and the volatility index is down for the day. It's done a complete 180 and flipped back. So when I said there may be some re-entry points available, there certainly are some potential re-entry points. We had the market's gap way down today on the indices and stocks and some other assets and oil and some other things moved down, and then we had a full recovery, refilling the entire gaps that occurred on many of these assets. And so now if you think they'll retrace through the gap back the other way, okay, there's a potential entry point. But right now the fear has subsided. The volatility index, what we refer to as the fear index, is in the red now, meaning fear is dropping. And it dropped a ton from earlier today, from this morning. So very interesting day with how the movements have gone. And we'll take a look at that in just a bit on some of the major assets, the main assets that were driven by this volatility. And so some things to look at. The feds in the US launched what they're calling the Main Street lending program, so the small business lending. Now, we read a bit about that last week, that there were some fears that the small businesses didn't want to take the loans necessarily because there was a minimum size to the loan, like $500,000 or something larger. And many small businesses were apprehensive to take that kind of loan because it has to be paid back. And so the size of these what they're calling Main Street loans for small businesses, some experts were fearful could turn away some of the small businesses. But it looks like maybe some of this momentum from this program launching has maybe helped turn the tide today with some of that fear that was out there. If we take a look, another thing that could have turned the fear today, you see here, trade, or this one here, New York Empire State Manufacturing Index. And you find this, by the way, on the economic calendar. When you go to investing.com, you click on economic calendar and it takes you here. And it has all of the day's announcements, all the week's announcements, really. You can look ahead days and weeks in advance and into the past. But today, what we see, positive news out of the US on this announcement, much better than expected. They were expecting the manufacturing index to be in the negative, not as bad as the prior month, but still large in the negative. And it actually was barely in the negative, 0.2 instead of negative 27.5, it was negative 0.2. So this helped create some positive momentum today as well. In the early afternoon, let's say, these numbers weren't so good out of the European Union, worse than expected on pretty much everything that rolled in. So the euro, maybe you'd look at maybe being bearish with these bad numbers that came in out of the European Union. Okay. That's pretty much it. There's an FOMC member that's speaking and talking about, being cautious and that sort of thing. But I don't think saying anything too major from the little snippets I've seen so far. So nothing to throw the market, the momentum off so much from what the FOMC member was saying from what I saw so far. So that's pretty much it in a nutshell with the fundamental news. We've got a lot of fear that subsided and refilled the gap. And now let's take a look. Mateo, you're saying what's it mean if they are positive or negative, those numbers? Okay, so if the numbers, let's go back to the screen. Good question. If the numbers here come in green in the actual column, actual compared to the forecast, if the actual column is green like these two, it means better than expected. That means the currency listed next to it over here, US dollar, okay, and the currency here, those you would expect maybe to be strengthened by that announcement because the news out of that economy was better than expected. And when we're looking in Canada, worse than expected numbers, right? Worse than expected by a large amount. If we look in Europe, worse than expected, okay? Italian numbers specifically, worse than expected, all right? So we would expect the Canadian, the euro to have bearish pressure based on these numbers, and the US dollar maybe to be buoyed a little bit because of some positive news coming in, okay? That's the gist of that. So when we go to the chart, this is interesting. Okay, we're looking at S&P 500. I forgot 15-minute candles. Let's walk through. This was the gap down at open. So Friday's close dropped at open for Sunday's open last night, early this morning. Okay, so this goes down here. And then what we saw then was momentum carrying that down further. And then a complete reversal coming back up today. Okay. Now, what we look at is if a movement drops below the low of the open, you trade down typically. So if we look at the open price, it was here. Okay. It opened here and then dropped a little further. It never completely re-entered the gap by much, went sideways. And then when it dropped below the low of the open, which was here, okay, this is where it opened. When it dropped below that, that signaled a downtrend continuing in the direction of the gap. So that's where your sell stops could have been put right here underneath this little trending area where it was ranging up and down, up and down, up and down. Once it broke in the direction that it had gapped down and then it broke to a downtrend below this little ranging area, you could have had a sell stop ready to go right down here. So there's your first profit spot. Once it started going sideways, you take profit. Okay, that's the strategy for trading in the direction of the gap. Once a movement re-enters the gap in a strong way, you can trade to fill the gap. And so once this movement came back up and re-entered the gap here, okay, here's where it gapped down to, this area here. Once it came up and re-entered the gap right in this location, then a buy stop pending order would have got you in to buy from here. So you could have been in on a buy. And where do you take your profit when you're trading to fill the gap? As soon as it gets to the top of the gap, which was here, this was Friday's close. This is where it gapped down from this morning. So once it got up here, near that fully filled gap, that's where you might take your profit. And look right where it paused now. That's right where it ran out of momentum. Okay. Mateo, maybe we'll revisit your question in a little bit. I'm not sure if maybe I didn't answer your question completely, but you could rephrase the question as well if I misunderstood what you were asking. Okay, so now we had some opportunities to trade in the direction of the gap here when it broke below the little cloud here that formed after it opened in a downward gap. It's going sideways, it breaks into a downtrend, boom, you're in with a sell stop pending order down here. To do pending orders, it's very simple. You would switch from market execution to pending, sell stop, sells from a lower point. You would have put your at price as being below this little trending area here, this little ranging area, I should say. And so your at price would have been down here. And when it broke below, boom, you're in with the momentum in the direction of the gap. Okay. At the same time, you could have programmed a buy stop pending order. Okay. Buy stop. Your at price for that would have been, if it re-entered the gap up here, here's the gap. If a movement re-enters a gap, typically it has a good chance of refilling the entire gap back to where it gapped down from. So a buy stop pending order here with the at price at about what, 3,000 would have been into the gap nicely. And once it entered, look what happened. It went flying up. Okay, so that would have been maybe a very easy potential profit there. Okay, so those two pending orders would have been great technical moves surrounding the gap. First, going in the direction of the gap as it continued to downtrend. Then, if it came back up and re-entered the gap like it did, trading to refill the gap, which it did completely now. Now, the question is, what's the next step? What's going to happen here? Will it keep climbing? Will it drop? And the answer is you don't have to guess. And by the way, you can look at most any of the major indices and they look the same. Okay, let me delete some of these lines. And we could look at the FTSE. Okay, you see the gap down, right? This was Friday, this was the open. It gapped down, it downtrended, it refilled the gap up here. Almost completely, not quite all the way filled yet. This one's got a little ways to go before it completely fills the gap. And we could look at other indices around the world. Also, a gap down here. It actually refilled the gap, then dropped, then refilled the gap, then dropped further. Okay, now it's trying to climb back up again as well. Very similar movements between many of these. You see the CAC 40 gap down, refilled the gap almost completely now. Okay, so as we look at these, we could say, what are some potential moves now? All right. All right, Mateo, I'm glad you figured it out. Yes, Philemon, the webinar is being recorded. Isaac, you can sell a short anytime you want, or buy it back, I guess we should say, right? So when you're selling, when you're going short, you can close it at any time you want. So this is an opportunity. If you think this is going to refill the gap again down, you could do a market move. So I could do S&P 500, sell, right? So I did a market move. Where might I put my stop loss? Okay, that's a good question. Where might I put my stop loss? Well, above this closing point from Friday that it just refilled up to. So I might put my stop loss, let's say above this resistance point here. Okay, here's a nice resistance point from last Friday. Here's where it gapped down from. And now it seems to be respecting that spot. So maybe I do a market move. I put my stop loss above Friday's resistance. And if it goes up and hits that, fine, I take a small loss, right? We all understand you could lose that move. But why might you choose to sell now? Because it just refilled the entire gap. Why did it gap down? Because there was a lot of fear coming in today about a second wave of coronavirus. Do you think that that second wave fear is gone? I don't think anyone came up with a cure from this morning or a vaccine that's ready to go from this morning. So probably that fear still exists. So whatever momentum brought the movement back up, and we looked at a couple things that might have killed the fear a little today, it looks like the fear is still causing it to resist going past Friday's close, the top of the gap. So if you were taking a sell now at the top of this gap, you could say, all right, if it refills the gap again downward, where might I take my profit? At the bottom of the gap would be the first spot a technical trader might say, I'll take profit here. Okay, so maybe at 3,000. So I could go back and put my stop loss and my take profit, modify. I could put stop loss at 30.50. Okay, and by the way, this is just an example. I certainly am not here to tell you exactly what to buy or sell on, but it's the strategy that I want you to understand. And right now we're doing a technical analysis strategy around a gap. Okay, we looked at what could have been done already today around the gap, and there were a couple strong moves that could have been nice winners for you. Now we're taking a look at what still could be done, right? So if I put my stop loss above the first resistance level, I put my take profit above the first support level, and modify. Okay, there we are. So my stop loss is about a half the distance or a third of the distance so I'm risking a lot less than my potential profit. And in both circumstances, I only need to go to the next price level, right? So to make 2 to 3 times the profit that I'm risking, I only need to go back and refill the gap to the first support level. And if I lose, okay, that's a measured risk. I've limited my risk, and there's a technical reason and a fundamental reason why I think that entry point might be nice, why it maybe should pay off for me, okay? And it's not a coincidence that this is dropping now off that spot. It doesn't mean it'll keep dropping, right? And a scalper might close soon. They might only want to fill part of the gap and take advantage of that resistance point that was there, because many times, even if the resistance is going to be broken, many times you'll get this bounce down like it's doing now off the resistance before it goes up and breaks it. So some traders are always in and out quick. They get in at the resistance, X distance down, boom, take profit. So you could already be a profit taker. Other traders are more patient, longer term traders, and you might wait until it refills the entire gap. Now that increases the likelihood that maybe it reverses back up and breaks the resistance before that happens, the longer you wait. But you know, you only need to be right, what, 50% of the time on a move like this, and you'll be profiting nicely, because in this setup, your potential profit is much larger than what we're risking. Type okay if you're with me on the reasoning behind this potential move. Why you might be interested to sell from this point, not because Troy said so, absolutely not, but based on the strategy, the gap strategy, and maybe that it will try to refill that gap. Okay, and you'll notice that it doesn't work every time, but you can make it work enough to profit, right? That's the key. It's not about being right every time, it's about profiting at the end of the day. And so this could be a very nice setup. And if I was a scalper, I might close now. Okay, boom, took 10, 12 $12 profit on a small trade. And had I taken a bigger trade, that could have been a really big profit, right? So there's some opportunities there. And you could, again, you could have done the CAC, you could have done the FTSE, you could have done, look, they're all starting to drop, right? The reason I like the S&P 500 is because the S&P 500 completely filled the gap already. It completely filled that gap. Some of the other indices didn't completely fill the gap yet, and some did. You just have to look and see which ones you like best. Probably the NASDAQ is also dropping, just starting to drop. The NASDAQ makes me a little more nervous because while some of the other indices have dropped recently, the NASDAQ has been able to push up still because some of the tech stocks, in particular Amazon and some other tech stocks that have done well through the pandemic because of online retail and things like that. So the S&P 500 tends to be, because it has more companies in it, right? NASDAQ 100, S&P 500, tends to be maybe better balanced and be able to go with the direction of the larger momentum more consistently. Okay, maybe a little more predictable for you. Okay, any questions at this point before we move on to another asset? Yeah, we can look at the Dow Jones. Oops, I double clicked instead of just sliding it over. Okay, so same thing. Here's the gap. The Dow Jones looks just like the S&P 500. Gap down in the morning, trended sideways until it started a downtrend. Here's your opportunity where your sell stop could have been set up below here. Exact repeat, exact same thing we saw in the S&P 500. Sell stop would have gotten in here as it broke this little support after the downward gap. There's one profit potential. And then I see you wouldn't have known how high this reversal would have went. So I'm not going to pretend to say you could have traded up on this move. But once this entered the gap here was where it gapped to. Once it re-entered the gap here, the buy stop pending order could have triggered and been in. So you could have had a sell stop down here, a buy stop, and went and did your daily business and left it alone. And it would have turned out you would have profited on both had you taken profit here once this consolidated sideways and taken profit on this one once it filled the entire gap. Okay, let me slide that up a little there. Okay, this is Friday's close right here. It came almost nearly all the way up, and now it's refilling, potentially trying to refill the gap back down now. This being the gap space here. Okay. All right, Mateo. And you know, you might say, okay, those are both U.S. indices, Dow Jones and S&P 500, and that's why they're so similar. That's why they gapped similarly. It's why their movement was similar. But remember, we looked at the European indices just a second ago. They did the same thing as well. So this fear is truly a global thing right now. And it makes sense because there's a global pandemic. There was a fear of another outbreak, a second wave coming. Okay. All right. So let's maybe look at something different than indices like crude oil. Okay. Look what crude oil did. Here's the gap down at the open. Okay. Let's follow the same method. Gap down at open to here. Okay. Gap down. It doesn't start an uptrend. It goes sideways and starts a downtrend right here. Okay. Up and down, up and down. It breaks the first support level that it formed. You could have had a sell stop ready to go. All right. At some point, you could have taken profit on this downtrend with oil in the direction of the gap. And all the while, you could have put a pending order up here and said, boy, if this breaks back into this gap, I'll buy on oil. And here it went. It broke into the gap here. You would have missed all this rise and still been able to profit as this re-entered the gap. There it went. It filled the entire gap all the way up. Here's where the gap started, right here. And it even broke past it. Okay. So your first take profit would have been on this down move. Your second would have been after it refilled the gap, probably right here. We'd have missed some of that climb if you were taking profit as it filled the entire gap back up to Friday's close. Okay. So same strategy, but on oil. Okay. Same strategy, but on oil. Right now, I'm on 15-minute candles, Grace. Okay. The reason I'm on 15-minute candles is it helps me see the gap really well. Okay. If I was on 4-hour candles, I wouldn't be able to see the gap so well. So this is a scalping strategy. So we're on 30-minute candles, 15-minute candles, even 5-minute. Okay. All right. So now, if you want to trade on oil, you're thinking, okay, what do I do? There's mixed news today, right? There was enough fear to cause a gap down and a run further down on assets like the indices, stocks, oil, etc. And then there was enough elimination of fear with good numbers out of the US, some other headlines that maybe helped, and up went oil, up went the indices, refilled the entire gap. Now the question is, what do you do? It's above the gap. How about a pending order? You don't have to do a market sell on oil. What if oil re-enters the gap? What if it breaks down to here, back into below Friday's close and back into this gap? You could have a pending order. What kind of pending order would sell if it breaks down to a price that you believe, oh, now it's going to refill that gap down? What kind of pending order would get you in to sell once it drops into the gap again? There's been, Mubarak, there's been some agreements on production cuts in the past weeks. That's helping oil to go up. It really is. So it's been, yeah, it would be a sell stop. Exactly. Some of you are saying that. So sell stop if it re-enters the gap. And if it keeps climbing, then you don't lose on the sell, right? Because you're waiting for confirmation of enough downward momentum that it re-enters that gap before you sell. So that's an option with oil. That's a technical strategy to say, okay, it's above the gap. I'll only sell if it breaks back down into the gap. Kind of like we did down here, saying I'll only buy if it goes back up into the gap. And that would have worked well. Now, if it re-enters the gap, maybe that's your signal to sell. Okay, it can work both directions. In this case, if you already won on the way up, even if you lost on the way down, you still could be an overall profit. Because if you enter a sell stop at this price down here, your stop loss only has to be back up out of the gap. Okay, you don't have to risk so much. I'm reading a long question, so that's why I'm pausing now. So just give me a moment. Okay, Ike, I'm glad that you're here. And yes, it can be helpful to learn some of these techniques. I'm sorry that you had some losses earlier today. Probably if you had known some of these strategies before trading this morning, it might have helped you out quite a bit, because these movements went pretty much textbook with what you expect to see with the large gaps that occurred. Trading in the direction of the gap when the downtrend reestablishes itself, trading to refill the gap if it enters the gap in a strong way. All of that worked very well today. So we could check back in the S&P 500 and say, yeah, still trying to fill the gap, isn't it? Okay, still trying to fill the gap. And if we go back to the fundamentals, we see the volatility index. Remember when we looked at it before, it was at -1.5 or so. It's almost back up out of the red, meaning fear is starting to go back up again. It moves in cycles. This is what happens many times. And so it's no coincidence that that's happening right as the gaps were completely filled. Then that helps swing the momentum back the other way. Okay. Now it's up to each individual. How long do you hold those positions, right? In the example I showed you, I took a small profit just as an example, but you certainly could be in it for a longer move as well. Maybe we look at one more asset and before we open it up for some more questions. Let's look at the Australian JPY. It's an interesting asset as well. Look at this. Gap down, just like the indices. Continue to downtrend, just like the indices. Reversed back up, re-entered the gap here. Okay, re-entered the gap. You see the strong breakthrough candle. That's where you get in with your buy stop, and up it went. So even getting in this late, after all that climbing, it re-enters the gap. If you had your buy stop ready to go, you got in around 73.50, and now it's at 73.73. Or I'm sorry, yeah, 73.73. So it's about 23 pips profit as it refilled the gap. Here's the gap. Okay, this is where Friday closed, right here. This was Friday's close. This was today's open down here. Okay, so this filled the gap right on cue. It reversed. You see this wick right here? Look here. Right at Friday's close, that's where this paused. Resistance, 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 resistance. So that's where the technical trader would take the profit on the fill the gap strategy. Okay. Now, if there's fear coming back, you might expect the Australian to drop against the yen. Why? There's two things working against the Australian here if fear is coming back. One is the yen is a safe haven currency. It tends to strengthen when there's fear. And the Australian tends to weaken if there's any fear about China and their economy. Yeah, Mubarak, you're on it. So China is like the biggest buyer of iron ore, coal, the major exports of Australia. China's their biggest buyer, has been for a long time. And so if there's fear that there's a second wave of virus breaking out in China, which I've seen some reports that they've had some of that, and that's what a lot of the fear was coming from this morning, then if that fear comes back, this gap could easily refill as the yen then would strengthen and the Australian would weaken, making it an easy move. Okay, so if you think this could happen, you could do a market sell right now, right? And where might you put your stop loss on this if you did a market sell? Because there's no guarantee you'll win, right? You could put AvaProtect on it. That's one option. You could put AvaProtect. It's available on this pairing. Or if you chose to put a stop loss, you might put a stop loss up there. Okay. Also, what if it breaks the resistance? If it breaks the resistance and trips the stop loss on your sell, you could have a buy stop pending order ready to go. Okay, a buy stop pending order ready to go. So your market move could be a sell with your stop loss above that resistance, so you don't have to risk much, and your take profit down here at the first support level when it fills the gap, if it fills the gap. And you back yourself up that if the momentum keeps being positive and it breaks this resistance by enough, you could have a pending buy stop to back up that market move. The buy stop goes in the opposite direction when your sell hits its stop loss. And then the stop loss on this would be back below, back into the gap. Okay, so a 1-2 type of move. Yeah, the recording, Mohammed, the recordings are all by the next business day. So by tomorrow, the recording of this webinar should be on our YouTube channel. Specifically, there's a section for English webinars. You'll see my webinars and you'll see Naim Aslam's webinars. He also does English webinars. Okay, good question. And you could just go to YouTube. If you don't have the link, you can go to YouTube and keyword search AvaTrade channel. You'll find it. Okay. All right. So this is testing that resistance. If it breaks through, you could get going in the opposite direction. Depends how close you put your stop loss, right? If you sold on this, how close do you put it? How patient are you? Do you put it just a little bit up, or do you put it above the next resistance level up here? Okay, that's up to each individual trader. And sometimes before you make your move, you look to see that it's downtrending. You might look to see that the high points have stopped getting higher and they started getting lower. So you might say it hasn't started downtrending yet. The high points are sideways. If you start to see the high point going lower and lower, maybe that's your cue that now it's refilling the gap, right? So there's different ways to go about that, but there certainly seems to be some pressure with fear trying to go back up again. So we've got some potential breakthroughs coming in the upward direction. We've got some potential gaps to refill if things reverse again today. Some huge potential moves. And because of the strategic entry points that are there right at the top of these gaps, you don't have to risk much to go after some nice profits. Okay. All right. Any questions before we end things here? Okay, great. So we've looked at some nice movements. We've got S&P still trying to decide if it's going to respect the top of the gap and drop. Same with the Australian JPY. You could get some pending orders above and below this gap and wait for the move. You don't have to guess with the market move. Yeah, Mateo, Mondays can be a little tricky sometimes. I like this time on Mondays though. I don't like Monday mornings all the time, but at this time, yeah, uh, Mubarak, gold went down with the fear, right? As a safe haven, that's weird, but it's been doing that a lot through the pandemic. People actually, when fear is so high, liquidate their gold to get cash in hand. Okay, so fear tends to drive gold up. Too much fear tends to liquidate gold as gold investors kind of panic and want cash in hand. So sometimes you just need to go by the fundamental or by the technicals with the breakthroughs and the reversals, which is exactly what we're looking at now, the technicals. And you could have done very good on gold today with the technical entry points and exit points, with the breakthroughs and the trends. On Friday, we'll take a closer look at gold, okay? All right, thanks everybody. Bye for now. Good luck with your trading.